Today is another great day to generate some cash flow. And for today, I've got another great example of how to utilize the dividend espresso method to maximize cash flow and buy a quality dividend stock at the right time. And in the wake of Verizon taking a dump after we bought it, I'm going to share with you an alternative way to get into this trade and protect yourself with a little bit of downside protection. As a reminder, guys, all of these trades I make, I talk about first in my Discord channel, which is part of the Patreon community. So if you're interested in that, getting all my spreadsheets, access to the trades I make, plus an awesome, truly awesome dividend investor community, check out the link in the description below. So in a previous video, we talked about how to jump in on Verizon Wireless right before the ex-dividend date at the right time to generate maximum cash flow. And then Verizon took a dump with respect to their price. I'm still a believer in this dividend espresso method, so then the big question becomes, how do we potentially protect ourselves from this happening on future stocks? So first off, let's talk about the dividend stock example, which I'm jumping into for this week, and that is Williams-Sonoma Incorporated, ticker symbol WSM. So Williams-Sonoma is a specialty retail company, and it includes the brand Williams-Sonoma, of course, but also Pottery Barn Kids, West Elm, Mark & Graham, and more. Remember, I only use the dividend espresso method to buy quality dividend stocks because I don't ever want to be caught below my cost basis and stuck with the stock that I don't like. So I'm only going to buy quality dividend stocks that I'm okay with holding long term if necessary. And Williams-Sonoma meets that criteria. Yes, they're in consumer discretionary and specialty retail, but they have 17 consecutive years of dividend increases. They're priced relatively close to their 52-week low, which was 109.22. Their revenue has grown over the past 1, 3, and 5 years. Their dividend has double-digit growth over the past 1, 3, 5, and 10 years. Current yield is actually a little lower than 3%, about 2.8%. They utilize weekly options, which is important. And their payout ratio based on free cash flow is really low at only 27%. So how do we utilize the dividend espresso method to capture dividend income, but also covered call option premium? And more importantly, how do we do this with maybe a little bit of downside protection? All right, we're looking at Williams-Sonoma, current price as of July 18th, $128.51 per share. And more importantly, from a dividend perspective here, you'll notice that the dividend is going to be 90 cents, which is paid quarterly. That was announced on the 15th of June. Goes ex-dividend on the 20th, which is 2 days from now, which means you have to buy it either today or tomorrow. All right, so how do we utilize the dividend espresso method? Well, number one, we need to buy the stock, which I've already done. Step two, we need to write a covered call. We've got two expirations here. We've got 3 days from now on the 21st and 10 days from now on the 28th. There's a few different ways we could approach doing this. In a perfect world, we want to capture the dividend and the covered call premium and maybe some capital appreciation, but a lot of things have to go right for that to happen. So one method, I would say the most aggressive, would be to buy Williams-Sonoma right now, let's say at 128.55, and then you could write a covered call out of the money at say 129 or even 130 and capture this option premium. I've got a special calculator for us to look at so we can look at some scenarios. So here's my dividend capture income calculator, which you can get access to by joining the Patreon community. So what we can look at is, let's say the price is right now 128.60 versus 128.55, close enough. Let's say we're going to buy 100 shares of WSM or Williams-Sonoma, and we're going to buy it at the current price, 128.60, and the dividend is 90 cents. Okay, goes ex-dividend on the 20th, and let's say we're working with the strike price of 129. We want to do an out-of-the-money covered call, and the option expiration is 7/21. And that premium right here would be 110. We're going to say right here for the 129. We have two different scenarios here. Number one, we get assigned at expiration and at our strike price, and we capture the dividend. This would be best case scenario, where we hold it for 3 days, the 18th through the 21st. We capture the option income, $110 right here. We capture the dividend because we're the owner as of the end of business on the 19th. We capture 90. Then we'd have capital appreciation of $40. We're assuming we bought it at 128.60 right here, and we got assigned at 129. So that's 40 cents times 100 shares equals $40. And that scenario, we'd have total cash flow of $240, option income plus dividend income plus capital appreciation, $240, 3-day holding period. And our capital required to enter this trade would be $12,860 because that was the cost of our shares. Our return on capital here our yield is 1.87%. And if we were to annualize that, meaning we can do it every 3 days, which is not truly realistic, would be a yield of 227%. It's much more realistic, I think, maybe still a struggle, but realistic to do this on a weekly basis. And if we did it on a weekly basis here, that would be, we'd say 7 days, and that would be a yield of 1.87%, and then an annualized yield of 97%, which would be pretty awesome. Now the other scenario would be an early assignment, meaning that the price zooms past 129, our strike price, and the buyer of the option actually chooses to take assignment to collect the dividend. You would think that's a terrible scenario for us, but it's actually not that bad. Here are the details. We still get to keep that option income, $110. We don't get any dividend here, but we do also get capital appreciation of $40. Again, the same strike price, $129, would be our assigned price, and we bought it for $128.60. So the difference is 40 cents times 100 is $40. The total cash flow in this scenario would be $150, but only in 2 days, right? Because we'd own it today, we'd have it tomorrow, and then we'd get assigned. Same capital requirement, $12,860, and our yield in this case would be 1.17%, which is the 150 divided by the 12,860. But that annualized yield would be 212.87%, assuming we could do that every 2 days, which again, not too realistic. If that happened to us every 7 days, then it'd be a yield of 60%, which is still pretty amazing. So this is a scenario under which we would buy the stock and then immediately sell an out-of-the-money covered call. But this doesn't give us any downside protection. So with this strategy, a slight tweak to our dividend capture, our goal is still to collect the dividend and covered call income, but we're gonna give up a little bit of the capital appreciation in exchange for a little bit more of a guarantee that we can get out of the stock quickly. All right, so let's assume right now we got the price at 128.91 or 98 here. Current stock price. Let's say we buy the stock for that amount, 128.91. We know that it still goes ex-dividend on the 20th, but instead of trying to get assigned on the 21st, we're going to do two things. Number one, we're going to utilize a strike price not above, but below our cost basis. So if the price is 128.91, we could either go with 128 or 127. Let's stick with 128 here. And we're also going to do it not on the 21st, which is in 3 days, but on the 28th, right here. So we're going to go to the 128 strike, expiring in 10 days, which will generate us between $295 and $320. So we'll go with 300 even right here. So notice what this does here. We're capturing $300 in option income, right? $3 times 100. Part of that is actual time value, right? We don't know what the price is going to do in the next 10 days, so we have some value for that. But also, it's below our price that we bought it for, $128.91 versus $128, which means that 90 cents of this premium right here is actually intrinsic value built into the stock. By utilizing the 28th of July instead of the 21st, there's more time value, meaning that even if the price is above our strike price, the option buyer might not choose to exercise because the stock price might zoom even higher in the next week. Now, let's look at our two scenarios here. Number one, if we get assigned at expiration and at our strike price, meaning that we get assigned on the 28th at 128, which would require the price to be above 128 at that time. In that scenario, we would still capture the dividend because we'd still be the owner as of the ex-dividend date on the 20th. So option income, dividend income, and this is capital appreciation. This is negative here because we're getting assigned below what we bought it for. We're getting assigned at 128, but we bought it for 128.91 right here. But that's okay because this $91 we're losing in capital loss we've been already compensated for inside of this option income right here. So in this scenario, total cash flow would be $299. All right, we've held the stock for 10 days. And our capital requirement to do this was $12,891. This is a return on capital when you factor in the actual cash flow divided by the capital required of 2.32%. And if we were to annualize that, meaning we can do it every 10 days, it'd be a yield of 84.66%. Now you're thinking, Joe, that's the best case scenario, but what if we get assigned right after we get the stock? What if somebody decides to request assignment because our strike price was below the market price? Well, that's okay because let's look at this scenario here. Early assignment due to the ex-dividend date, meaning we get assigned prior to the ex-dividend date, which would just be 2 days for us, the 18th and the 19th. In that scenario, we still capture the $300 in option income. We don't get the dividend, but that's okay. And we lose this capital appreciation, right? We lose this $91, same as before, but again, we've been compensated for that in here. Total cash flow would be lower here, $209 instead of $299. Same capital requirement here, but our yield in just 2 days would be 1.62%. which annualized would be 300% nearly. Now, it's not realistic to actually hold a stock for 2 days consistently and get assigned, but let's say we could do that once a week. 7 days here, which would lead to an annualized yield if we could do it once a week of 84.54%. Now, to be clear, this wouldn't always protect us, and it wouldn't have fully protected us with Verizon, but it's a way for us, in case the stock does drop after the ex-dividend date, it does give us compensation for that extra week and the potential ability to get the stock called away no matter what within 10 days. For full awareness, I've already jumped into WSM in my own portfolio utilizing this exact strategy. I'll let you know what happens afterward, or you can follow in the Discord community now and get up to date on what that strategy is, how I jumped into it, how others in the community might have also jumped into WSM or other similar stocks. Hopefully you found some value in this video, guys. Make sure to leave your 2 cents down in the comments below. It's my goal to respond to all comments left on the day I post a new video. That's all I got for you guys in this video. Have a great rest of your day, and thanks for watching.